In 2023, Binance alone generated an estimated $12 billion in revenue. One company. 1 year. $12 billion from a product most people think is just a website where you swap coins. That number is not a typo, and it is not an accident. Crypto exchanges are some of the most profitable businesses ever built, and the vast majority of their users have absolutely no idea how deep the money machine actually goes. Welcome to BlockVault Daily. Today we are pulling back the curtain on exactly how crypto exchanges make their money. Not just the obvious stuff like trading fees, although we will cover those in detail, but the hidden revenue streams, the structural advantages, and the one business model buried inside every major exchange that most people never think about. By the end of this video, you will never look at a crypto exchange the same way again. And honestly, once you understand this, you might rethink how you use them entirely. To understand how exchanges make money today, you need to understand where they came from. The first real crypto exchange was AmiGoX, launched in 2010, originally built as a trading platform for Magic, the Gathering cards. It pivoted to Bitcoin almost by accident. At its peak, AmiGoX handled over 70% of all global Bitcoin transactions. It had almost no formal revenue model. It was charging around 0.5% per trade and barely surviving. Then it collapsed spectacularly in 2014 after losing approximately 850,000 Bitcoin to hackers. But AmiGoX taught the industry something critical. Volume is everything. If you can capture trading volume, the revenue follows automatically. That lesson shaped every exchange that came after it. Coinbase launched in 2012 with a cleaner interface and more structured fees. Kraken went live the same year with a focus on security. Bitfinex followed. Then Binance arrived in 2017 and completely redefined the space by doing something radical. It temporarily cut fees to the bone to capture market share faster than anyone thought possible, and then it diversified its income streams so aggressively that fees became just one piece of a much larger puzzle. So let us talk about trading fees first, because they are still the foundation of everything. Every time you execute a trade on a centralized exchange, you pay a fee. The industry standard ranges from roughly 0.1% to 0.5% per transaction depending on the platform and your trading tier. That sounds tiny. But here is the math that changes your perspective. Binance regularly processes between $10 billion and $20 billion in spot trading volume every single day. Even at 0.1%, that is $10 to $20 million in fees collected in a single 24-hour period. Every day. Day after day. The number compounds into something almost incomprehensible at scale. Most exchanges also use a maker-taker fee model. Makers are traders who add liquidity to the order book by placing limit orders that do not fill immediately. Takers are traders who remove liquidity by filling those orders instantly. Makers typically pay lower fees or sometimes no fees at all. Takers pay more. This system rewards patience and punishes urgency, and it also incentivizes high-frequency traders to park enormous amounts of capital on the platform, which makes the exchange look more liquid, which attracts more users, which generates more fees. It is a self-reinforcing loop. But here is what nobody talks about when it comes to trading fees. Exchanges charge fees on both sides of a transaction in some models. The buyer pays a fee. The seller pays a fee. The exchange collects twice from a single trade. At high volumes, that structural double dip is worth billions annually. Now let us go deeper, because trading fees are honestly the least interesting part of this story. Withdrawal fees are a quietly massive revenue stream. Every time you move cryptocurrency off an exchange to your own wallet, you pay a withdrawal fee. These fees are framed as network transaction costs, but the amount the exchange actually charges is frequently higher than the real on-chain cost. The difference goes directly into exchange revenue. Multiply that across millions of withdrawals per month and you are looking at hundreds of millions of dollars annually from a service that costs the exchange almost nothing to provide. Listing fees are another significant income source that most retail traders never consider. When a new cryptocurrency project wants to be listed on a major exchange, they pay for that privilege. The figures vary enormously depending on the exchange's prestige and traffic, but credible reports from within the industry suggest that a top-tier listing on an exchange like Binance or Coinbase can cost anywhere from several $100,000 to several $1 million. For smaller exchanges, fees might be lower, but the model is the same. projects essentially pay for access to the exchange's user base. And because exchanges typically require projects to lock up tokens or provide liquidity, the arrangement often benefits the exchange multiple times over. Staking and savings products represent one of the most important modern revenue streams. Exchanges now offer users the ability to deposit their crypto and earn yield through staking, lending, or flexible savings products. The exchange takes the deposited capital and either stakes it on the underlying blockchain, earning validator rewards, or lends it out to institutional borrowers at higher interest rates. The exchange keeps the spread between what it earns and what it pays users. This is essentially traditional banking, rebuilt on a blockchain. Coinbase earned hundreds of millions of dollars from staking services alone in recent years. Binance Earn, which is Binance's equivalent product, manages billions in user deposits. Users think they are earning passive income. They are, technically, but the exchange is earning significantly more from the same capital. Margin trading and futures products deserve their own spotlight here. When a user opens a leveraged position, they are borrowing capital from the exchange. That borrowed capital carries an interest rate, paid hourly in most cases. These funding rates stack up fast. A trader holding a leveraged position open for days or weeks is paying interest continuously. During high volatility periods, funding rates on some platforms have hit annualized rates that would make credit card companies blush. And when leveraged positions get liquidated, which happens constantly in crypto markets, exchanges often collect liquidation fees on top of everything else. But here is the insight that genuinely surprises most people. The biggest exchanges are not just exchanges anymore. They are financial ecosystems with their own native tokens, their own blockchain networks, their own venture capital arms, their own NFT marketplaces, their own payment systems, and their own launchpad products where new projects raise money. Binance has BNB. Coinbase has the Base blockchain. Crypto.com has Chronos. These native tokens serve multiple functions, but one critical function is revenue enhancement. When users hold or spend the exchange's token, they often get fee discounts, but the exchange benefits because token demand drives token price, and exchanges typically hold enormous reserves of their own tokens. Rising token prices directly enrich the exchange's treasury. Exchange launchpad products are worth examining closely. Binance Launchpad and similar products on other platforms allow exchanges to host token sales for new projects. Users lock up the exchange's native token or other assets for a chance to buy new project tokens at early prices. The exchange charges the project a fee for hosting the sale. The project benefits from exposure to millions of users. The exchange benefits from increased demand for its native token, because users need to hold it to participate. And the users who win allocation feel rewarded, making them more loyal to the platform. It is a brilliant three-sided market that generates revenue, loyalty, and token demand simultaneously. What does all this mean for the average crypto user? It means that every interaction you have with a centralized exchange is a microtransaction in someone else's revenue model. Every trade, every withdrawal, every staking deposit, every leveraged position, it all feeds the machine. That is not necessarily a reason to avoid exchanges. They provide real value. Liquidity, accessibility, ease of use, these things matter. But understanding the economics makes you a smarter user. You start shopping for the best fee structures. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Block Vault Daily for a brand new video every single day. We will see you in the next one.